Okay, Chapter 24, Performance Measurement and Responsibility Accounting. As this probably suggests, this is a lot tied to compensation, both to yourself as a manager as well as your employees and so forth that you might tie contractually. So it's an important area. Again, responsibility accounting provides information for managers to use in performance evaluation as well as compensation, because often their compensation will be tied to hitting goals or hitting certain benchmarks and so forth. And then they assign costs to managers who are responsible for controlling those costs, and I'll get into that in a minute in greater detail. I'll give you a personal example. Large complex businesses are divided into departments, and so enabling managers to have a smaller effective span of control is a term you're going to see more later, especially in management. And it's just how much of an area do you control, how many people are reporting to you, as an example. And again, companies do departmentalize as they grow in size, and they'll have a production department, a sales department, or a service department, and what have you. Could be shipping department as an example. And then you're going to have to evaluate these departments. How well are they functioning as the company grows? Are they keeping their costs down and so forth? And there are different types of department evaluation. So, for instance, a cost center will be evaluated on ability to control costs, where if you have a P&L or profit and loss center, your ability to generate revenues in excess of expenses. So you're managing not only the expenses and the cost, but also generating the revenue. And then an investment center, are you just simply managing your money, and you evaluate their return on assets or return on investment and so forth. So there are different strategies depending on what kind of a department it is. Uncontrollable versus controllable cost. Cost is controllable if the manager has the power to determine or at least significantly affect the amount incurred. The example they're using, supplies used in the manager's department. Whereas uncontrollable costs are not within the manager's control. And for instance, the department manager's own salary, or maybe the advertising for selling the product when you're in charge of production. And these surprisingly get merged together. And if you're astute, you can negotiate these out of your contract. And I'll give you an example here in a minute. Responsibility accounting, again, provides information related to individual managers and their ability to evaluate how they're controlling on their items that they do have power over. So you'll see this often. It's actually somewhat important, but this is an organizational chart, more commonly known as an org chart, and this is typical of a company. You'll have the board of directors, which is elected by the shareholders, who in turn hires the president or the CEO. And then the CEO or the president will then hire his executive staff, and it could be vice president of finance, operations, marketing, and there could be more, human resources as the company grows and so forth. And then these people in turn hire the store managers, and then maybe their supervisors on the floor. So this person's span of control is all of this, but specifically this area, and these go further down and so forth. So you don't want to have a store manager getting costs that only the VP of operations can control and so forth, although they will try. But anyway, so an org chart is important. This is also the reporting line. However, there is also the politics of an organization, and sometimes that will be through dotted lines where it's sort of unseen. So don't think that this is the only pattern of power in a company. There is also political dynamics. So again, they get into the amount of detail versus the level of organization. A department manager receives very detailed report, and whereas maybe farther up just gets summarized information and so forth. Very, very typical. Reports should be timely, issued regularly, understandable, and compare definitely one component, especially when you're talking about people's compensation. And people will get very focused and will learn the game as it is played. Controllable costs and so forth, like what they're really trying to tell you here is that they're just trying to give you some example. Maybe these consulting charges were not in your area, but maybe they're trying to bill you for this and so forth. Controllable costs versus maybe some other things, some benchmarking that you're going to get tied to. Direct expenses are incurred for the sole benefit of a specific department, and then indirect is benefit more than one department and are allocated among departments benefited. This is an area that I think as a manager you should focus on, and because the company will shove down a variety of indirect expenses to you, and often they expect you to take that at face value. Maybe they'll take part of the executive overhead and allocate it to a variety of departments. And often you cannot change this, but there are times when you can. I'll give you an example. Once that I did was I ran a division of a company that was brokers for. I was a VP of sales and department manager for a brokerage operation for a large savings and loan in California, and I had about 75, 80 employees up and down the state of California. Our corporate headquarters had a major health facility and gym facilities, and they allocated that gym expense to me. Well, I only had maybe half a dozen employees that was at the corporate headquarters, and the rest were up and down the state of California, would never use such a thing. And so I argued with the CFO that I should not be allocated on the full basis that he did, and that he should take that off. And of course he fought me for a while, and then I was willing to take it upstairs. And so I did get that expense taken out of my budget. And so that would help my profitability, because I was getting paid on profitability. What do you think he did? He reallocated to everyone else that expense. So in some ways, I was taking other people's bonuses and put it in my pocket. Welcome to the game. This is how it's played. And other managers are going to do the same to you. So you should learn this game. And one of those is the allocation of these indirect expenses. So be forewarned. An illustration of an indirect expense allocation. Here they have a janitorial service and per month to clean the store, but it cleans 3 departments, and so they're going to spread it out and so forth. Can you maybe argue these allocation methods? I would look into it. Don't take it at face value. Doesn't mean you're going to win that battle, and you have to pick your battles carefully. But sometimes that's one way to improve your performance in the department. Again, indirect expenses, wages and salaries, and they allocate it based on maybe square footage of your floor, how many people. Again, how they allocate these expenses, you might want to look at the methodologies here. And is it really fair or reflective of your department? Don't take it at just first blush. They might be shoving stuff over to you that's maybe wrong, and it's hurting, especially if you're being paid on profit and loss and you're getting added expenses that don't really factor into your controllable or viable to your department. So this is something to be cautious of. Again, they're just giving you some allocation methods. Maybe it's based on number of employees, maybe it's based on number of purchase orders, floor space. You're just going to have to learn how that game is being played. Okay, I'm going to stop here and then we'll start another video.